Greetings and welcome to Module 6. This is an action-packed module. We're going to be covering a lot of territory. Not only are we getting into inventories and talking about some of the valuation methods like FIFO, first in, first out, or LIFO, last in, first out. You may have heard of those. We'll be talking about accounts payable and long-term assets, including things like depreciation. A lot of this is a way of getting information or dollars transferred from our balance sheet to our income statement. Things from inventory going to cost of goods sold. Things, long-term assets, we depreciate. If they're fixed assets, property, plant, equipment. If they're intangibles, we don't depreciate. The term is amortization. So we amortize those terms. But let's go ahead and take a look at inventory. Why the heck is inventory significant? And some of those other methods that we mentioned, not only FIFO, LIFO, but average cost, specific ID, and the retail method are kind of important to know about and be aware of. But we'll start with inventory. Big reason for inventory, big bucks. Let's take a look at Philip Morris Tobacco. They have 8.7 billion, that's billion with a B, in inventory. Out of a total of 41.3 billion in assets, that's 21% of their balance sheet is classified as inventory. And by the way, don't even get me started. Where do you put $1.6 billion in tobacco leaves? One of my students, a math student, calculated that for warehousing, we would need a warehouse the size of the distance from Francis Marion over to MUSC. A lot of square footage to store tobacco leaves. Don't know how long they dry, utility costs to go with it. It's expensive stuff. Even at Walmart, we've been talking about Walmart, $56.5 billion in inventory out of $244.9 billion in assets. That's even higher at 23.1% of their balance sheet. So what's the cost of inventory all about? Well, if we look at inventory, we got to put it somewhere. We were just talking about buildings for tobacco leaves. You got to put stuff on shelves. You got to pay utilities. You got to cover security guards. You got to pay insurance. You got equipment to move it around. You got breakage. You got people. You have obsolescence and spoilage, potential shrinkage when it disappears, property taxes, yada, yada, a whole bunch more. A lot of costs associated with inventory beyond just the inventory. But if we're looking at just the inventory valuation, we got to finance that inventory. That inventory doesn't appear on the shelf for free. We got to buy the stuff. And we'll talk about raw materials, work in process and finished goods, parts of inventory. But if you were estimating a 10% cost of interest on that 8.7 billion in Philip Morris, that's $870 million just in interest expense. With Walmart, that's 5.65 billion, again, back with that B, in interest charges. Just think, if they cut back 10% of their valuation on the inventory, they would cut back 10% reduction in the interest costs. So they save $500 million in interest with a 10% reduction. But the other side of it is, if you don't have inventory on the shelves, often you can't sell it. How many people go buy a car and order it, willing to wait 6 weeks? Although nowadays, I guess you need to do that. But usually cars are purchased, you can drive it, you can sell it. Let's take a look a little further into the flow of costs associated with inventory. So we buy inventory, we capitalize it. We put it on the balance sheet. We do not have inventory expense. No such thing. We do have cost of goods sold at the time we sell it. So when it moves out of stock, goes into the customer's hands, we're going to transfer that inventory from the balance sheet to the income statement. Category it falls into is cost of goods sold. So what's this capitalization term? We use that a lot. We capitalize equipment, meaning we put it on the balance sheet. We don't expense it right away. We expense it over a period of time. We capitalize our inventory as well. It means we record it on the balance sheet, don't expense it, and we base it on cost, our purchase price, not our selling price, but whatever we paid for, historical cost. When we manufacture things, it's kind of interesting. You say, well, you manufacture, I can put the raw materials in there. I know I got my car, I picked up some batteries, I've got material in the seats, I've got engines, I've got tires. Okay, those are all costs, but we also can inventory labor, and we can inventory overhead costs. So that stuff gets put on the balance sheet associated with the vehicles we produce if we're Ford. associated with manufacturing of computers if we're Dell. So those are things that are included in inventory. You say, how do I inventory labor? Well, that's how you do it. You just take the cost associated with labor, the cost associated with overhead, and the cost with raw materials, put it there. Now, materials, labor, and overhead, when we get into managerial accounting, we'll be doing a lot more discussion on that. But those are the costs we're associated with. So let's look at the costs. This chart, the beginning inventory plus inventory acquired is goods available for sale, minus ending inventory is cost of goods sold, or minus cost of goods sold is ending inventory. I'm going to go ahead and do a little bit of a little whiteboard work here just to demonstrate that for you. So if we're going in and we're going to start with beginning inventory, that's some stuff that's sitting on the shelves already. We buy stuff, we have purchases. From there, we total that. We have something called GAS, or goods available for sale. So everything that we bought and already had can be sold. Stuff that was on the shelf and we added to the shelf. Then we're going to subtract our goods sold, and that will equal our ending inventory. By the way, you'll notice you could probably subtract ending inventory if you do a physical count and figure out what you sold. This is a formula you're going to want to know, be familiar with, be comfortable with. We're going to use it a bunch when we talk about inventory. All right, let's go ahead and clear that out. Get back to our previous PowerPoint. So as we said, the beginning inventory is a carryover from the previous ending inventory. Then we add our purchases or manufacturing costs. So purchases, wholesale, retail, distribution, often, and purchases of raw materials, but then we have our own labor and overhead that we add to that. So we have goods available for sale. Let's say cost of goods sold, good cost of goods available. If we go a little further, we'll see that we can calculate gross profit. We've done this a bunch. You take your sales minus cost of goods sold, and it only becomes cost of goods sold when you sell it. It's moved from inventory. So sales and receivables are at selling price at retail. Cost of goods sold and inventory are at cost. And then the comments here, if higher cost units are transferred from the balance sheet, then cost of goods sold is higher and gross profit is lower. If lower costs are transferred, we have a higher gross profit. And we've got some choices on that. That's why LIFO and FIFO can make a big difference. I'm going to end this video for part A of Module 6. Then we'll jump in and we'll actually be doing LIFO, FIFO calculations in part B. But I wanted to make sure you had a reasonable handle, a reasonable overview, a good perspective, picture of where we're going with inventory. Thank you for listening.